Hello and welcome to the latest Moneymakers Investment Trust podcast with me, Jonathan Davis. A reminder that for regulatory reasons, nothing you hear today, however stimulating and insightful, should be regarded as constituting individual investment advice or a specific stock recommendation. Them's the rules we have to work with. For the final edition of the podcast this year, I've taken the opportunity to invite 4 of the regulars who've been on the podcast over the last 5, nearly 6 years that it's been going, to give me some thoughts about what happened this year and what 2026 might bring, particularly for them personally looking at their own portfolios. I thought that might be an interesting way to round off what has been a very interesting and indeed exciting year, I think it's fair to say, for investment trusts. An awful lot of activity going on, a lot of deals, a lot of consolidation. The investment trust sector continues to shrink. Discounts are creeping in, but very, very slowly. Equity investment trusts still trading a little bit below, in single figures on average, but nearer 10% than 5%. And alternatives still suffering significantly. The average discount there is well over 20%. And that is something that is really not sustainable, I don't think, over the longer term. But we've had, as I say, lots of news this year. 2 names, Donald Trump and Saba Capital, have, I think, been the most dominant ones as far as investment trust investors are concerned. But different kind of outcomes in both cases, I think. If you like, the Trump onslaught, the trade wars, the tariff announcement, they really threw the markets earlier this year. But I think now it does appear that the markets have at least got a measure of what the Trump administration is about. And the initial fears that he might ride completely roughshod over the things that matter to investors have eased somewhat. The tariffs, well, there have been lots of trade deals. They've not all been implemented yet. And some of the higher tariffs that he threatened or indeed implemented at some point have all been in general reduced. And I think more importantly, the bond market has shown that it has got an eye on the Trump administration policies. There's a lot of stimulus coming, tax cuts, and that, in the short term, might be very positive for risk assets in the short term, but doing not a lot to assuage concerns that the fiscal extravagance of the US government and many others will in time have to involve some kind of reckoning with the bond market. There's got to be some effort to constrain spending and continued deficits at some stage, whether that's induced by a crisis or just by some kind of revolution in a government or two. But for the meantime, politicians have an incentive to go on spending what they can. And that will continue, I suspect, until something brings it to an end. Not a particularly encouraging backcloth, but it does mean that there is room for markets to do well again in 2026. But there's also increasing risk of some sort of crisis, whether that could be a big sell-off in the Mag 7 or the big tech stocks that dominate the US market and driven it to very high valuations. That could easily happen. But other things may be not quite as bad as we originally feared. Meanwhile, as far as Saba is concerned, well, they got rebuffed at their attempt to requisition and take over the running of 7 investment trusts a year ago. That they're still there. They've made some money from some of their holdings, and they've recently added more in the alternative sector for the first time. Now they have, I think, something like 38 disclosable holdings. In many cases, that game, if we can call it a game, has yet to play out. It's taken up an awful lot of time and energy on the behalf of the boards most in the crosshairs. But I'm one of the camp who believes that net, if you like, after taking allowance for all the cost and disruption involved, the arrival of Saba Capital has been positive for the investment trust sector to the extent that it has forced a lot of boards to accelerate their plans to try and tackle the discounts, which are, after all, the price that shareholders look at when they study their portfolio holdings. Overall, though, it's been a pretty good year for investment trusts, I'd like to say. A lot of good performance. Majority of investment trusts have delivered absolute returns, and quite decent ones, kept pace with the markets overall. And some spectacular performers, such as anything to do with gold or mining, the top of the list. Biotech's made a good recovery. And the UK equity market itself has actually done reasonably well, outperforming the US market, to the surprise of many. So there's been lots to be pleased about in 2025. And 2026 is going to be a very interesting year. I shall be talking about that later. You will, I hope, forgive me for making the point that if you are in a position where you want to take stock of the year that's just gone, all the things that have happened, and my goodness, there have been a lot. No better way to do that than by buying a copy of the Investment Trusts Handbook 2026, out now, or taking advantage of our offer that you can download a free PDF version of the entire 336-page edition by going to the Investment Trusts Handbook webpage or via the Moneymakers website. That's money-makers.co. I look forward to hearing how you get on with this year's edition, which has been a great pleasure to produce, as always. So I'm going to invite you to listen to these 4 participants who I asked to tell me about their best moments in 2025 and what they're looking forward to or fearing in 2026. My first set of questions went to Ben Conway, who is the head of fund management at Hawksmoor Investment Management and a periodic contributor to the podcast. I asked him these same questions I put to a number of leading authorities in the investment trust world, interested what they think about the year just gone and the one coming up. So Ben, I'm going to start by saying, what was the best moment for you in 2025, the year that's just coming to an end?
Best moment, very clearly for me, is a relatively recent one, just the beginning of December, with the policy statement from the FCA putting an end finally to our nearly 4-year campaign on cost disclosures for investment companies and how they're treated, with victory in terms of our campaign and that funds that now own investment companies do not have to treat investment company costs in an incorrect way.
Second question, what has been your worst moment in 2025?
I would suggest it's the Third Point fiasco, which for me demonstrated that nothing illegal was done, but I think was abuse of minority shareholders in the conversion of an investment company into some sort of listed insurer. And it was the ability of one very large shareholder to effectively force minorities to accept a holding in a company they didn't want to have without giving those same shareholders any sort of fair exit on the way. And I thought that was a very, very poor governance. It's a shame that the investment company is afflicted by these things, I think is the fairest thing to say.
So this was Third Point Offshore Investors, as you say, which is managed by a US hedge fund manager. And they have about a 30% holding, I think. And they offered a cash exit, but only a minority of the minority shareholders, if you like, got it. Yeah. What are you hoping for in 2026? What's on your Santa Claus wish list?
The Pension Schemes Bill, investment companies holding the assets prescribed under the Mansion House Accord, that for investment trusts that own those assets, that they should be part of the Pension Schemes Bill. So if a pension fund were to invest in an investment trust that holds those prescribed assets, it would contribute to the 10% that they are encouraged to hold under the new Mansion House Accords. It was a real shame that investment trusts weren't automatically included in that bill, but there is a lobbying effort underway to remedy that. And if successful, I think that would open up a large constituency of new demand from pension funds into the sector.
And what are you most worried about or most fearing for 2026?
My biggest fear is actually probably more episodes and more evidence of poor corporate governance in the sector. I think we've just had a few too many over the recent past, and it really doesn't help the sector when you see these things. I've already mentioned the Third Point one, but sadly I could mention quite a few more. So I'd really like to see perhaps more examples of steam governance and fewer examples of very poor governance.
Can you give me the names of 2 trusts that you either own or you think will do well in the year coming ahead? It's not a recommendation, just asking you what you own, which you are particularly encouraged by.
So the first one, I'll choose a private equity investment trust. I think we're sport for choice in the sector. I think they're all pretty good, actually. I think they're all run by very talented managers with good track records, and governance is getting better all the time in that sector. But I think the environment for realizations, that is the sale of private equity holdings, is going to improve and has been improving quite dramatically as uncertainty diminishes, particularly sort of Trump-related uncertainty. But the one I would choose is Oakley Capital Investments. You had Stephen Tredget on your podcast recently, so I'd encourage people to go and listen to that. Fantastic track record. They have a particular niche in investing in founder-led businesses in certain sectors. They've got a wonderful track record. The governance is very, very good. Note how many shares that they purchase. Note that they cancel those shares as well. And the discount has been narrowing encouragingly as well. So that'd be the first one I'd mention. And the second one I mentioned is Cordiant Digital Infrastructure. Cordiant invests what they would describe as sort of the plumbing of the internet world. I think you've also did you have Stephen Marshall on the podcast recently?
Well, earlier this year.
Yeah. And so the wonderful thing about that business is it's not just the fact that they're operating in some of the fastest growing economies in Europe, so in Czechia and Poland. It's not just the fact that they are on some of the most exciting parts of the internet plumbing infrastructure, including AI data centers, but the balance sheets managed very conservatively. So the point is that lots of their investments are going to require follow-on capital investment. And while they're trading on a discount, which means they cannot rely on the equity market to fund that, they've got plenty of other routes to fund financing. So they're thinking ahead. They're not getting into that awful trap that some investment trusts come into, which is they've got these wonderful assets, but they can't support them because they're trading at discounts and can't raise finance that way. So they have to fire sale them at far below fair value prices. So Cordiant ticks that box. The other thing as well is how cheap it is in terms of the ongoing costs. Because their fees are levied on market cap, not net asset value, and because they're trading at a really wide discount, you're getting a bargain in terms of what the ongoing costs that's taken off the NAV. It's about 67 basis points. So for this quality of management, the quality of the management team, the quality of the assets, the bargainous price that you're buying them on, I think it really stands out.
I would just throw one other factor, which is, well, certainly Stephen Marshall, who runs it, he has a large shareholding in this thing as well. So he's aligned.
Very much aligned, very much eats his own cooking. And as I said, I think the governance is pretty good there. You won't necessarily see loads of buybacks, but that's because a better use of their liquid resources is actually to support their existing investments, such as the return on investment there. So yeah, I think watch this space. I think things will get better and better for that one.
And finally, what about two trusts that you won't be investing in? Again, these are not recommendations to sell. They're just things that don't meet your criteria for whatever reason. You might explain what those reasons are, of course.
I'm glad you're going to put that qualification in because one of these trusts is actually quite a good one. But I mean, the first thing to say is that the sector is just so cheap. You can find quite a few trusts that have got, in inverted commas, problems, but I think those problems are largely reflected in the share price. And we don't do things like short selling investment trusts, but even if we did, I think I'd find things quite difficult at the moment. But one of the trusts that perhaps we wouldn't invest in is JP Morgan Global Growth and Income. Really good 10-year track record, a little bit challenged more recently, but you can't argue with a really long-term track record. Governance is actually pretty good as well. Trades quite tight, is really big, really liquid, and its ongoing costs or expenses are really low as well. So you're probably thinking, why are you saying that one, Ben? Well, because I think that in this day and age, the investment company has to really prove relevance and it's making every use of the structure. And for us, that means that we're not really going to invest in investment companies if they're investing in the most liquid parts of the equity market, and particularly when the investments that they hold are some of the very largest investments that you can perhaps access even more cheaply via ETFs or passive funds. So that's one. So if anybody associated with that trust is listening, you're doing a great job, but just it's not for us. And the other one I would mention is BBH, Bellevue Healthcare. And we didn't really like what the board are doing there.
They have been doing a lot, I should say. They've been sort of zigzagging along with different initiatives from one month to the next, more or less.
Yeah, I mean, the latest update there is that they want to change the mandate and change the manager. And the manager that they want to change to has got a fantastic track record, but it's a very short track record. It's less than 3 years. So the first thing we'd say is, when you change a mandate that dramatically, it's still a mandate operating in the healthcare sector, but it's going to be more of a hedge fund, a long short structure. You should really be giving shareholders who don't want that a full exit. Now, I should just say that the strategic review is ongoing, and I believe they're consulting with shareholders. But I just think that when you look at the size of that trust, I think it's about 125 million market cap, and they've got an existing buyback that requires them to keep the discount narrow. So it's been shrinking quite dramatically. So that 125 market cap, it keeps getting narrower and narrower. So your post-strategic review liquidity might not be amazing, and you're going into a manager that might be fantastic, but the track record just isn't there. So will I be buying those shares today without necessarily a guarantee of an exit at NAV? Well, probably not, especially if I'm saying that don't necessarily think that the mandate that they're going to is something that makes best use of the structure or has got a great track record. But kudos to the board for doing something. I should stress that the consultation, I believe, is ongoing, so we don't know the final aspects of that particular review. So things may improve.
Next on my list to answer some of my questions about the year just gone and the year to come is James Carthew, who is a director and head of research at Quoted Data, the investment trust research firm, and a former fund manager to boot. So, James, let's kick this off. You've been following the sector every day this year, like me. What was your best moment in 2025?
I think it was quite early on in the year, actually, because we had all of the SABA votes, the various requisitions. And the first one of those that actually got a result was Herald. That came in as a resounding victory for the trust against SABA. In fact, if you discount SABA's votes, I think only 0.15% of investors supported it. So that basically knocked the whole thing on the head, really. It set the tone for all the votes that followed, and hopefully the tone for the new attack that we're going to see on Emerald Worldwide in the new year.
Yes, he has come back for more in December. Obviously been a lot of activity from Saba this year, but as you say, those 7 votes at the start of the year turned out to be pretty decisively against him, and that forced him to change his tactics and also energised the sector. I think that's fair to say. And certainly private shareholders came rallying to the call of the boards. What about the worst moment in 2025? What would you offer us on that one?
That was probably bizarre, really. That was Liberation Day, as so called, where Trump's tariff announcements. So we knew they were coming, but we didn't know what was going to happen. And then this sort of really peculiar methodology that he applied to calculating those. So we've got one Vietnamese trust that we work with, but I'm an investor in a couple as well. And, so it's something that we take keen interest in. And Vietnam was the worst hit country. So he put tariffs of 46%, and not surprisingly, the share prices dived. Then we had a really terrible time in markets. It wasn't just Vietnam, there's a whole bunch of other things. So bond yields went mental and stock markets plunged in various markets around the world. And he chickened out. So we had this whole taco trade thing. Trump always chickens out. And then they did come back and renegotiate, and Vietnam, I think, ended up with a 20% tariff, which I think they can work with. They're definitely still quite optimistic about the growth from that country. But on the day, it just seemed so mental and, it wasn't predictable. It was really quite a nasty surprise.
Certainly as a piece of sophisticated policy, it was not that. Anyway, we can be clear about that. It seemed to be on the back of an envelope with a very basic calculation which made no economic sense. But as we see now, we come to the end of the year, the markets seem to have learned to live with Trump. I think we can say that. And his bark has turned out to be worse than his bite. And, well, it's been quite a good year for a lot of investors, despite or perhaps in part because of what he's done. What are you hoping to see in 2026? What will be your piece of good news that you look forward to?
Well, we've had a bit of good news just in the last couple of weeks where the FCA has come out with some new rules around cost disclosures. So what I'm hoping to see in 2026 is that the wealth managers and the institutional fund of fund investors that have been deserting the sector in droves to actually start to make a comeback. That would be really helpful. That would be really good news because a lot of the big discounts that we've seen are because of that. So with that out of the way, then hopefully we're going to see a bit more of an interest in the sector and a gradual narrowing of those discounts.
I suppose the positive argument being that even a modest return of the marginal buyer could have a significant impact on discounts and drive share prices back up towards NAV.
Yeah.
What are you worrying about in 2026, or what do you fear might happen in 2026 that will take a bit of shine off that announcement and perhaps the market's recent strong performance?
I think you might get the same answer from a lot of people, which is the AI, the sort of valuations that we're getting in the US mega cap market. Some of those do look really stretched now. It depends, really. If the investment keeps going on, if the capex keeps going on, then you can kind of justify a lot of those valuations because the profits will keep coming. But it's the end return on the AI that's the question mark. And so we could see an awful lot more run up still in the valuations of those companies. But if it bursts, then I think it's going to be quite upsetting event for the market because obviously those big mega cap AI stocks do dominate markets now. They dominate world indices even.
Yes, and therefore, if that happens, you need to be able to move quite quickly into the right things to own at the right time.
Or make sure you're diversified now, really. That's partly it.
Because markets in these kind of technological changes, they tend to be fairly short-termist in their thinking. They don't think it through to the second order, third order until something triggers that happening. I couldn't agree with you more than that. Okay, so given that background, give me 2 trusts you either own or think will do well, and why.
So I own both of these. So first one I've got is RIT Capital Partners. And I've picked that because it's on a fairly big discount. It's about 22 discount now, which is wider than it should be. It's definitely been wider than that, but nevertheless, I think it's still too cheap. The whole point of it is a sort of wealth preservation trust. So it's supposed to grow investors' capital over the long term, and they've got a pretty good track record doing that. And partly they've got a pretty good track record of doing well when markets go down or relatively well. So they're not going to not lose you money. There are some trusts that go more extreme than that, like capital gearing or personal assets or something. But RIT is still designed to be a bit defensive. And yet within it still, there's still got quite a lot of great stuff. So there's some interesting investments in there that I think might come good.
Just to follow up on that, how far do you think they've been penalised because they do have and have long had fairly significant holdings in private equity?
Yeah, and that might be the reason why the discount arose in the first place. The market's got a little bit worried that they had too much private equity, but they have been selling that already. There have been quite good realizations this year. As we see more exits, as the exits come through, the NAVs go up. So I think that actually could be quite a good place to be.
And there's a new regime in place as well, managing the investments there. That's one. What about a second one?
The other one I'm going to pick is GCP Infrastructure. Again, it's on a big discount. I think that one's about 28, 29. Very chunky yield as well, about 10%, but relatively, and this is always going to caution it, relatively safe in that because it's an investor in infrastructure debt, it's cushioned from the worst effects of any kind of downturn in that market. Not that these things tend to be much affected by market cycles and stuff anyway, or economic cycles. So quite sort of a cautious, steady Eddie manager. Phil Kent, he's a good guy. And I just think, again, it's unfairly trading at a big discount. So we could see some kind of narrowing of that. And the trigger for that is that they've been talking for a while about making a disposal, which would have the effect of both allowing them to free up more capital to return some cash to shareholders through buybacks to narrow the discount that way. But also it's designed to make it even less sensitive to shifts in things like power prices and stuff. So I think the twin effects of that could help it get re-rated.
And are you more positive about that one than you are about other infrastructure trusts or the renewable ones?
It's a safer bet, put it that way.
Okay, moving on then. Let's get to two trusts that you will be avoiding this year, at least as far as you can see at the moment, and why you would be thinking that.
Right. Okay. So what used to be JP Morgan Russian is now called JP Morgan Emerging EMEA. It's just the wrong price. Well, it looks like it's trading on an enormous premium, and it looks like that because back ahead of Russia invading Ukraine, it had quite a lot of investments in Russia, obviously, because that's what it did. And suddenly those investments became worth nothing. They couldn't sell them and they couldn't get the money out. So they're still sitting there and they're valued at zero. So a lot of investors, definitely not me, have been ascribing some kind of value to that. And they're putting an enormous premium on what's left of the trust. And increasingly, it looks to me like Russia's going to settle that money. There's various court cases in the works against JP Morgan, and this is one of the defendants in that, where they're trying to basically say, you've got to sort of surrender those assets to us. And I think it would be a quid pro quo thing. So if we use the Russian money that's in Belgium to help pay for Ukraine, I think they'll say, sorry, mate, you can't have your money back for JP Morgan, and the court cases will go their way. You know, I don't have an awful lot of faith in the independence of the judicial system, but so you could end up with those things being worth zero, in which case that share price is going to look very overvalued. And then the other one, which trades at a premium, people seem to love in the issue stock, but I just don't get, is Henderson Far East Income. It's very high yielding Asian equities, and it's overdoing it on the income front. So there's a massive compromise in terms of the total return. So that it's just not making the capital profits that it should do, given it's invested in Asia. And I just think that's a bit overblown. And again, it's probably overvalued.
Final question then, James, and that is, are you more optimistic or less optimistic about the outlook for investment trusts than you were 12 months ago?
I think some of these things that have been nagging us for a while, like the cost disclosure stuff, have been resolved. The Saba stuff, it depends how rational he is in as an investor, really, because he's got enough money to create havoc if he wants to, but it wouldn't make sense for him to do that. So by and large, I'm a bit more optimistic. And there are lots of things that could come from left field that actually could turn out to be positives. UK small cap is so oversold, but there's nothing obvious on the horizon to turn that around. But if something did come along, like say the government did something positive for markets, then you could see that running quite strongly. So there's lots of little things that could come right. So yeah, I think I am a bit more optimistic, but you've got to be, otherwise, you
wouldn't be doing this job.
Exactly.
Okay, so that was James Carthew, Director of Quoted Data, talking to me about his hopes and fears for 2026. You are listening to a Moneymakers podcast. We are an independent research and publishing venture, and grateful to JP Morgan Asset Management for their generous no-strings financial support, which enables us to keep the podcast free and our editorial principles intact. Each podcast episode goes live shortly after being recorded, with a weekly catch-up email notification every Saturday afternoon. Why not also try our premium weekly subscription Moneymakers newsletter, which provides a comprehensive summary of all the latest news, results and performance data from the investment trust sector, with links to the relevant stock exchange announcements if you want to go down that rabbit hole. and many other regular features including more than 170 in-depth and independent trust profiles, regular market commentary and videos, plus the editor's list of favourite funds. If you never want to miss a thing that might affect your portfolio, do please sign up today at money-makers.co. And if you follow this podcast on YouTube, please do use the subscribe and like buttons. Thank you. My next port of call was to speak to Anthony Leatham, who is the head of investment trust research at the broker Peel Hunt, very active participant in the investment trust market. My first question, Anthony, to you is, what's been the best moment in 2025 for you?
Well, it's been a busy year, fair few highlights. I'd maybe start with the performance of investment trusts. I think in spite of all the negativity and headwinds, investment trusts have delivered fantastic returns. If I look at our data sheet and look at the year-to-date share price performance and rank the top 30 best performing trusts, you're looking at an average share price total return of 49%. And that beats things like the MSCI All Country World Index, the S&P 500, the FTSE All Share, which I think is not a story that gets enough attention, really, in the broader market. It's also been a fantastic place for income. So again, if you sort the top yielding trusts, the average yield has been about 11%, which, to put that into context, we've got the 10-year gilt trading around 4.5%. So certainly some interesting aspects of the investment trust world are playing out there. And I guess the other highlights would be some of the corporate activity, most notably the take private of BBGI, which I think kind of started the process of a series of transactions across the investment trust sector and also across the alternative space. And I think we're only really at the beginning of a period of potential consolidation or further corporate actions in the sector. And the final point I'd note is the strength of shareholder engagement in that early 2025 round of SABA requisitions. The ability and willingness for shareholders to be engaged with this process and have their voices heard. This concept of my share, my vote needs to continue into 2026.
So as you say, plenty of positives there. What about your worst moment in 2025 or the worst thing you think happened in the sector?
Oh gosh, we're glass half full. We like to focus on the positives, but it has been quite tough out there, no doubt about it. I think one of the points that we keep referring to is the kind of net flows for UK equities, particularly from domestic investors. It just feels like we've had a sustained period of outflows, particularly notable in the second half of this year. I think some of the data providers suggesting that October was one of the worst or the largest monthly withdrawals on record. And I think it is frustrating to see whether it's asset allocation frameworks move away from UK equities or even institutional investors, most notably pension funds, seeing actually a reduction of allocation to UK rather than an increase. So we'd like to see that trend make a swift reversal. We also felt some disappointment around sources of market uncertainty, particularly around domestic policy. So things like the UK budget or the consultation on subsidies, the ROC and the FIT subsidies, the threat of taxation changes and the potential implications for investors and savers.
As a quick follow-up to that one, do you think that, if you like, this flight from UK equities actually has affected UK-listed investment trusts, even if they have global mandates? In other words, is there a kind of spillover that way as well as directly?
Yeah, I think we do feel it in investment trusts. I mean, these are listed vehicles. They are part of broader indices, which themselves are subject to flows from passive investments. And if you think quite often, if a global asset allocator wants to participate in the UK market, they tend to look at those indices first, maybe even buy into, say, an ETF or some sort of passive vehicle, which buys the whole of that index. Investment trusts are in those indices, and as we've seen previously in bouts of market volatility, the share prices on those investment companies can correlate to the broader market, the domestic market, rather than necessarily the underlying fundamentals of the portfolio. So yeah, flows do make a difference, probably on the short term, but it is a factor to consider.
So what are you hoping to see in 2026? Are you going to see another year like this, or are we due a bit of a correction? What do you think?
Well, at the top level, I think we would like to see further progress with encouraging kind of UK savers and investors to enter or re-enter the UK market and hopefully see some foreign investor flows too. I think what we would ideally like is see some stability really in some of those macro indicators, stability in inflation, and the potential for further decline in the interest rate should help to encourage some recovery in those higher yielding alternative sectors.
And what are you most afraid of might happen in 2026? What could spoil this otherwise potentially interesting outlook?
Well, I guess one of the challenges for active managers has been the fact that some of these major equity markets have been dominated by a small number of stocks or themes. And that concentration can be really problematic, but it can also lead to potentially overvaluations across certain sectors. So that's something to watch out for. If we see greater breadth in the equity markets and increased dispersion, that should favor the active managers. And investment trusts are blessed with a number of very talented managers who've managed money through cycle. So we'd expect them to outperform in a broader environment. The macro noise and uncertainty is unhelpful. We all know it. We all feel it. I just hope there are no more conflicts or exogenous shocks that could cause knee-jerk risk aversion. What we know from investment trust performance behavior, we talked about performance earlier, is that in times of uncertainty or volatility in markets, investment trusts do have a habit of overreacting, and that can be unhelpful in a portfolio context.
Perhaps I just pick up on one thing we haven't really talked about, which is the response of boards to what's been happening. We've had this consolidation trend, obviously, but we've also had SABA and others appearing on share registers and forcing votes, and perhaps some would say giving a kick to some boards that have been a bit dilatory. But do you think that, if you like, the message has now got through to boards that actually they do have to be more proactive? And it would be interesting to see whether they can sustain that if we do run into a period of extra volatility. I don't know how you would think about that.
Yeah, my experience is that I think boards have actually been on the front foot. Over the last few years, we've had almost like a refresh cycle of boards. And certainly if someone joins a board, looks at the strategy afresh, looks at the performance, looks at the discount volatility, etc., there is scope to bring in other features or changes that can improve the outlook for investors. That could be at the fundamental investment manager level. Either do we have the right manager in place, or is the strategy fit for purpose? Or is it that the fact that the discount has been entrenched and more needs to be done to encourage it to narrow? So I do think boards get criticized quite easily in this environment. And you understand why, if you've got a vocal activist criticizing as well and pointing out errors, that then can sometimes skew the argument. But I would say that they've largely been on the front foot. And in a more volatile environment, you'd expect to see a pickup in buyback activity, but also further consideration of other mechanisms. For example, tender offers. We've seen a few mechanisms either triggered by the discount level or performance-related tender offers, which actually creates really strong alignment between the manager seeking to outperform their benchmark and the shareholders wanting to see that outperformance come through to reward them for being in the closed-end fund vehicle.
A couple of years ago, I recall you did a bit of research and you said that share buybacks in themselves don't always produce results. And I think we've seen that in a number of cases in terms of narrowing discount, but they do reduce the discount volatility. Do you still stand by that finding? Has that played out as you expected?
Yeah, we do. And I think there is still some degree of skepticism in the market, and understandably so. If you've spent tens, if not hundreds of millions of pounds buying back your own shares and the discount hasn't budged, then you're starting to question whether it's working or not. What we said at the time, and I think what we maintain, is that if you have a buyback strategy that does little and often, so you're in the market regularly, you're showing intent in terms of addressing maybe a buying and selling imbalance, and you're signaling to the market that you're interested in reducing that discount volatility, that typically works. So the difficulty is we've got a range of strategies and styles of buyback at the moment in the market, and some are more effective than others. But certainly what we've also seen is it's not just an equity trust phenomenon. You've seen the alternatives, particularly in the private equity sector, adopt some quite innovative capital allocation policies, which also seek to address that concept of a persistent structural discount.
So against this background, can I ask you to give us a couple of examples of trusts, or perhaps sectors, if you don't want to be too specific, that you hope will do well in 2026?
Yes, the old crystal ball. Need to dust that off and take a look. We're watching the recovery in healthcare very closely, in particular the biotechnology sector. In fact, if you look down the list of trusts in that particular sector, we have an abundance of manager skill available. But we are looking at, for example, international biotechnology to do well in this environment. We've already seen the start of the recovery, but actually with regards to some of those policy headwinds that we experienced in the last few years, I think there's much further to go within that sector. I also find myself drawn to areas that have done badly that might recover and do better. And in the context of strong corporate earnings and weak US dollar, we could see continued support for a rally in emerging markets. And following a volatile year in the Indian equity market, we look at Ashoka India Equity to deliver strong outperformance.
And by the same token, what do you think might be a sector or a trust that is perhaps worth avoiding for now, at least that you will be avoiding for now?
We've talked a lot about discounts. I think we'll be avoiding those trusts that are cheap for a reason. So where the discounts look attractive on paper, but the risk is that they are in fact value traps. And in that context, we're cautious on Gore Street Energy Storage Fund and SDCL Energy Efficiency Income Trust. Both trusts are trading at discounts wider than 40%. And whilst it's tempting to pick up a portfolio at less than 60p in the pound, there are a number of issues that we're concerned about, including, for example, the quality of the portfolio, fluctuations in the NAV and the net asset value, concerns around corporate governance, and the potential for dividend uncertainty, which are all factors that would support our cautious outlook.
So that was Anthony Leatham, the head of investment trust research at Peel Hunt, talking to me a little bit earlier, looking back at 2025 and forward to 2026. My final call for this end-of-year special podcast was to Max King, former fund manager at Investec, now a regular and prolific writer on matters to do with investment and specifically to do with investment trusts, one of his favourite topics. So I'm going to dive straight in, Max, and ask you the first question. What was your best moment as an investor in 2025?
Well, I have to say it's really a personal one. During the year, on the spur of the moment, I sold my 3i at, I think, £43 and put the money into RIT a little below £19, and then was shocked to see a couple of months later the 3i share price coming back quite sharply, but the RIT share price progressing upwards. And I think actually the new management of RIT is doing a pretty good job and their investment returns will pick up. And 3i is a great company, but you're basically buying a discount retailer in action, and that accounts for 75% of the share price. And I decided I wanted to invest in 3i rather than just a discount retailer. In fact, I decided that some years ago, and actually I sold half my 3i stake about 3 to 5 years ago, decided quite quickly I'd made a mistake and bought them back the next day. And the lesson there is that, you know what, if you do something and you decide almost straight away that it was a mistake, just buy them back. I'm so glad I did.
Indeed, but they've continued to trade at a premium, and the premium's got bigger a lot of the time. So at some point you must have thought, well, presumably you did when you sold them the first time, you thought that that might be unsustainable. Was that your thinking, or was it something else?
Yes, I thought they were too dependent on action and that the valuation was aggressive, but I then sort of quickly realized that the valuation wasn't aggressive. In fact, it was probably rather cautious and there was a lot more growth to go for. And of course, there was good potential in the rest of the portfolio at 3i. So I'm a very happy holder.
What would it take you to get back into them again?
I think another rule of investment is don't look back. When you sell very well and then you see a share price fall sharply, it's tempting to think, you know what, I got that right. I sold well. I'm a really good trader in this stock. I must buy it back. And actually, generally, it's a mistake. You know, you sell, leave it alone for at least a year, and then think of it as a new investment if you want to, but don't go back. But I have to put alongside that the fact, as you asked me, my worst investment, well, it's not my worst investment this year, but my worst decision was one I took about 2 or 3 years ago, having held gold mining shares for about 10 years in a gold mining fund. And it's only this year I realized what a terrible mistake I'd made in selling them 2 or 3 years ago and reinvesting the money in an oil and gas fund, which has done nothing ever since. The reason why I sold 2 or 3 years ago was just the sort of feeling that although the gold price was going up, gold mining shares weren't responding. And the reason they weren't responding was ore grades were falling, costs were rising. And I thought, you know what, this is never going to work. And how wrong I was. I have to say now, I think the gold is looking very toppy. I'm amazed that you hear people talking about how the US market is in a bubble, which is up 15% or 16% year to date. But nobody thinks gold price is in a bubble, even though it's up 60%. It makes no sense to me.
Okay, so let's look forward then and say, what are you hoping for in 2026? What would make your year as an investor?
Well, what I'd like to see is greater participation by British retail investors, especially women, because I don't think women in this country invest in the stock market very much. And I think that ought to change. Everyone's focused on getting more women in professional jobs and on boards and managing businesses, but no one's focused on actually getting them to invest in the stock market. And I think that needs to happen. But in the UK, overall, there are huge piles of savings which have been building up. The savings rate is high. There's huge piles of savings in deposit accounts. And actually, the UK market still looks good value. British companies or British-based companies are increasingly well run and have done well this year, and I think will go on doing well. And I think next year we can start to look forward to a change of government. And actually, markets always discount. And I would hope that starts to happen in 2026. So by the time we actually get a change of government, people will say, well, it's all in the price.
How, out of interest, do you think that change in government might come about? Because obviously there's a popular narrative that if Starmer is sort of eased out, then it'll be some more left-wing leader who will take over. But that's presumably not the scenario you have in mind.
I'm not assuming that they'll run less than their full term. Markets do look a long way ahead. Changes in terms of spending and tax, they're only for the next 2 or 3 years, and they will be reversed. So there's no assumption that there will be a speedy change, just that it will change and will change for the long term. And actually, when I look at the UK economy, I don't think it's particularly difficult to reinvigorate the British economy. I think there's a whole raft of taxes which could be cut and actually increase both growth and revenue. If, for example, taxes on oil and gas extraction, you could cut them and revenue would shoot up, or the VAT rebate on tourists. So there's some really easy wins. I think on the spending side, there's some very easy wins which would raise growth. So I don't think actually, when the time comes, turning the British economy around is going to be a particularly difficult thing to do.
And what are you worrying about or fearing might happen in 2026? It's not going to be a change in government, which you might not be worrying about at all. What would make you a little bit unhappy?
Devaluation of sterling. Every period of Labour government in history, every single one, has involved the devaluation of sterling. So I'm not holding my breath that this time it will be different. We're up to 134 against the dollar. I think, if you sell your gold, for example, I'd probably recommend keeping your money in dollars or yen or euros or Swiss francs rather than sterling. I'm worried about sterling because history tells you it's going down, as it always does under a Labour government.
Okay, so then let's turn to something a bit more specific. Can you give me the names of 2 trusts that you either own or particularly feel will do well, and why?
First one I'd say is Pershing Square. They've got a real home run on their shares in Fannie Mae and Freddie Mac. But I think there's much, much more to go for. These are not listed companies. They're traded over the counter on very low multiples. And it seems inevitable that the US government will list them as part of a privatization process. The US government's stake in Fannie Mae and Freddie Mac is worth $300 billion. That's not something that they really want to dismiss out of hand. I think they'll want to get hold of that money eventually. A listing would multiply the share price further, and Pershing Square would be a huge beneficiary in net asset value terms, but I think it would also result in the discount falling dramatically. So that would be one of my 2 tips. The other would be Edinburgh Worldwide, and we've seen good news on them the last week, but I think they've got great news in the pipeline still to come on SpaceX and Cyquant and some of their other unlisted holdings. And I have to say, I was rather dismayed at their proposal to merge with Baillie Gifford US as part of their defense against Boaz Weinstein. I think that was a very defeatist thing to do. You can't negotiate with Boaz Weinstein, so I think that they should really just fight to the last. After all, Weinstein may have had a point about performance a year ago, but a year on, the performance has been good, and there's much more in the pipeline, and they have, I think, sharpened up the investment focus.
So do you think the board was unwise to allow this situation to develop where Saba now sits with a 30% holding or whatever it is, roughly?
I don't think they could prevent it, but what they were unwise to do was to try and compromise by a merger with Baillie Gifford US, another very good fund, but it is a different fund. Baillie Gifford US is 100% US. At present, Edinburgh Worldwide is, I think, 73% US, But it won't be like that forever. In time, they may well move more overseas, to Asia, to Europe, who knows? Maybe even the UK one day. They don't need to be under the same umbrella.
The logic of that proposal seems to be that if you put the two trusts together and offered a 40% exit to people, that would be how you would get rid of Sabre off the register. But I think Sabre have been very clear that they actually see the value in SpaceX themselves.
They don't want an exit. What they want is to get control.
Exactly so. So finally then, Max, two trusts you will be avoiding and why?
Well, I'm still wary of the renewable energy stocks because I just think the trend of energy prices will continue to go down. And I think that these trusts, their dividends are unsustainable, their gearing is too high. I think they're trapped. And maybe we're near the bottom and in the longer term, they'll turn around and revive as possible. But I just don't think you need to own them. Particularly, I wouldn't own the solar companies because solar power makes sense in Spain and Morocco and Italy. I don't think it makes sense in Britain. Even when the sun shines, it usually shines weakly through a veil of cloud. And you just can't get the usage out of solar energy in the UK that you need. So I have to say, I'm not sure these shares will go down a lot in price. I just think they'll be dead money. And I think you want to continue to stay clear.
And presumably you're not very keen on the fact that the government has made some proposals for changing the subsidy regime, one of which at least would do serious damage to the renewable trusts that already exist.
Yeah, well, that's the first small step, but there'll be other steps to follow. I can't see how dear Ed Miliband is going to survive. If he's pushed out, then his replacement is going to be much less friendly towards renewable energy. I can't see how either this or a future government will not cut back quite heavily on renewable energy subsidies. The UK is now way out of line, even with Europe, on renewable energy policy. So, I think the news is going to be all the wrong way for the next few years. And that what these companies have to do is batten down the hatches and survive, and some of them won't. But I suspect some of those solar wind farms will be ploughed up and resown with potatoes or whatever.
Quite a mouthful, I think that would be. Very good. Okay, so that was Max King, former fund manager at Investec, now a regular and prolific contributor to many publications, including Money Week. I'd like to thank all of my guests who've appeared on this festive edition of the Moneymakers podcast. It only remains for me to thank you all for listening in so many numbers this year. Continue to enjoy doing the podcast. I've been honoured and privileged to have won another award for the podcast Best Broadcast of the Year in the AIC Awards, and I hope you'll continue listening into 2026. And we'll continue to find out what happens next. So, happy Christmas and Happy New Year to you all, and look forward to having your company again for the balance of the coming year.
Thank you for listening. The Moneymakers Investment Trust podcast is independently produced and edited and is freely available on YouTube, Apple Podcasts, Spotify, and other podcast channels. You can also sign up at money-makers.co to be notified of each new edition. If you want more news, analysis, interviews, and other investment trust content, don't forget to look at the Moneymakers Circle, available for a modest subscription at the website.